Good morning, everyone.
Morning.
I welcome you all to this VCM on international taxation on this Friday, 10th June morning. We have with us a very eminent faculty, CA Siddharth Parekh from Mumbai joining us, who would be addressing the session today. And we also have a presence of Chairman of Nagpur Branch, CA Jiten Saglani, Managing Committee members, CA Swarupa Vasalwar, CA Trupti Battad. On behalf of Nagpur branch of ICAI, welcome all the participants joining on this occasion. To start with, I request Chairperson CA Jiten Saglani for his welcome remarks.
Yeah, thank you so much.
So there is an echo.
Just do we need to mute someone?
No, you can continue now. You are audible.
Sure, fine. So the key faculty of today's session, CA Siddharth Parekh from Mumbai, who happens to be a very good friend of mine, and I have been connected with him for quite a few years now. The chief guest of today's session in absentia, CA Sanjay Kumar Agrawal ji, who happens to be the chairperson of this committee on international taxation. Regional Council members, CA Vijit Kelkar in absentia. Committee members of the Nagpur branch, CA Ajay Vaswani, CA Trupti Battad, CA Swarupa Vasalwar, and other committee members who will be joining very soon. So I just wish to recognize them: CA Sanjay M. Agrawal, CA Akshay Gulane, CA Dinesh Rathi, CA Sanjay C. Agrawal, and CA Deepak Jethwani. Past chairman of the Nagpur branch, I am seeing CA Saket Bagadia, who has recently joined. Other members of the Nagpur branch and members across places who are connected to this VCM. I think we have more members outside Nagpur who have been attending today's VCM. We'll be seeing them shortly. So friends, a very good morning to everyone, and I welcome you all to the forum of Nagpur branch. And this VCM today on international taxation was actually planned a couple of days back. And CA Sanjay Agrawal ji, Sanjay Kumar Agrawal ji, the Central Council member, who had actually accepted our request and allotted us this VCM. So I wish to thank him first because he was instrumental in hosting us this particular VCM. I also wish to convey my regards to Siddharth Parekh for accepting our invite and being as a wonderful speaker here. I think you guys will be learning a lot because he has been a faculty as well as throughout a ranker. So and his knowledge on this subject is so much that I think a couple of hours will not be enough, but still we have limitations of time. So we'll be having his session for 2 hours today, and maybe someday later we'll be having one more session of his. Friends, it's rightly said that debt and taxes are the only constant. So I think taxes is something which we all are like, as a chartered accountant, we deal day in, day out. And we as a council wish to guide our, say, clients appropriately. But this particular area, that is international taxation, has lot many changes. And we all feel that we should be updated. And that is why this session is being organized. And I hope that Siddharth will be covering up basic areas wherein the say status of being an NRI, residential status and all will be covered. Also will be taking us through the various nitty-gritties which are important when it comes to an international taxation, NRI taxation. So I think this will be a wonderful session. Wish you all a very great learning today. And with this, I wish to conclude, but I wish to again convey you that we have a wonderful session tomorrow as well, which is on IBC, Insolvency and Bankruptcy Code. This is a session 3 in the series, wherein stress assets and its resolution will be covered by CA Prasad Dharap. Apart from that, on coming Monday, that is 13th of June, we have other VCM, which is happening on incentives and MSI schemes. So basically, there are a lot many schemes which are which are there for people who are into business, and to have those schemes, the incentives, we have this session which is wherein we'll be having 2 speakers, say Zulfesh Shah and say Anuj Chandak. Say Anuj Chandak belongs to Aurangabad and say Zulfesh Shah from Nagpur. We have more such sessions lined up in next week. So please stay tuned with the efforts of the Nagpur branch, and we'll be connecting you once again very shortly. Thank you, one, and thank you all. Over to you, Ajay.
Thank you, Chairman sir, for your brief opening remarks. Definitely, today's topic is a very interesting one, and it has a very way ahead in the opportunity as a practitioner. Definitely is one of the key offbeat area of practice. But considering the scope and this is a good topic that we have organized, and I'm sure with a very eminent faculty, C.A. Siddharth Parekh addressing the members today, there would be a very good learning experience. To have a brief introduction about and knowing about the faculty for the day, I request Managing Committee Member C.A. Trupti Battad to do the honor.
Thank you so much, Ajay sir. A very great morning to one and all. It's my privilege to introduce the speaker of the session, C.A. Siddharth Parekh sir, who is a partner at Sunil G. Parekh and Company Chartered Accountants, specializing in the fields of international taxation and transfer pricing. He has done his BCom from R.A. Poddar College, Mumbai, where he secured first rank at university level. He has also Bachelor's of Law degree from Government Law College, Mumbai. Not only this, he has secured 21st rank in CA final exams also. Apart from this, he has done Master of Advanced Studies in International Tax Law from International Tax Center, Leiden University, Netherlands. There also he secured first rank with honors. He has also done Advanced Diploma in International Taxation from Chartered Institute of Taxation, United Kingdom. And if I talk about his working experience, he has worked with E&Y both in London and Mumbai office. He has also worked as a teaching assistant at International Tax Center, Leiden University, Netherlands for international tax and transfer pricing topic. He has written an article on various topics, including the concept of options realistically available, limitations of benefit clause under double taxation avoidance agreement. And if I start briefing about each and everything, it will take another 20 to 30 minutes. So I'll cut it down and request everyone to please put your hands together and welcome C.A. Siddharth Parekh, sir.
Thank you for those kind words.
Thank you so much, Trupti. So without taking much time and coming between the faculty and the audience, I directly request Siddharth sir to please take over the session. Sir, the platform is all yours.
Thank you, Ajay. Thank you once again to Jiten bhai, Ajay bhai, Trupti ma'am for providing me with this opportunity. As Jiten bhai rightly said, the topic for today is something of relevance for all practicing professionals. And it's definitely an emerging area wherein we see both individuals and companies either going outside India or NRIs coming and investing back in India. And in this day and age, it is really essential for us to understand, some of the nitty-gritties, especially related to the residential status, especially how some of the tax implications work based on what we come across in our day-to-day life. I'll just start my presentation now. Just give me a minute. Ajay, is my screen visible?
Yes, sir.
If any point of time, if I lose connection or if I'm not audible, Ajay, please.
Yeah, definitely.
Do interrupt me or give me a ring.
Sure, sir.
Okay. Thank you. So as I was saying, the topic for today is basically dealing with taxation of non-residents. And I must admit that initially, when I accepted, the kind offer which came to take up this topic, I probably was clueless that it's almost impossible to finish, covering all the provisions and the nitty-gritties in a span of 2 hours. What it has meant is I've tried to emphasize a bit more on the provisions which are applicable to individuals, given that a lot of us deal with non-resident Indians in our practice more often compared to corporates. But at the same time, I've also dealt with some of the more common provisions which are applicable to foreign companies, and emphasizing on the amendments which have taken place in the last 1 or 2 years. At the last part of the presentation, I've also dealt with some of the IT return filing aspects in terms of which forms are applicable, how to deal with some of the specific schedules which are applicable as far as disclosures for foreign assets, foreign income, tax relief is concerned, etc. So now let us start with the first leg of our presentation, which deals with the residential status and the scope of total income. So the first question is, why is it important to correctly determine the residential status? As you would all know that the scope of total income is defined in Section 5. And Section 5 specifically provides which types of income are taxable in case of residence, which types of income are taxable if you are resident but not ordinarily resident, and which types of income are taxable in case of non-residents. Given this, the first point of call always will be accurately determining the residential status of the taxpayer. This is not only important for the assessee himself, but it's also important for the person who is making a payment. Correct, because that would in turn also inform which are the withholding tax provisions which are applicable in case payments are made either to an individual who is a non-resident or even to foreign companies. All of us are well versed with the provisions of Section 195, the requirement, especially by banks requesting for Form 15 CBs and CAs, whenever remittance needs to be made outside India. The third reason why residential status is also important is for because there are certain provisions in the Income Tax Act which specifically deal with only non-residents, especially their tax rates and some specific computation mechanisms as far as capital gains are concerned. The criteria for determining residency provision, as we know, is contained in Section 6. So that is what we'll start off with now. So this is the text of Section 6.1. As we all know, the test for residence for individuals is contained in Section 6.1a and 6.1c. Be careful that there has been an amendment in Section 6.1c, which was introduced by Finance Act 2020 with effect from AY 21-22. I've highlighted the relevant text in underline. So the basic condition which is contained in Section 6.1a is that an individual needs to be present in India during the previous year for 182 days or more. So this is basic condition 1, and which is contained in Section 6.1a, and it is an alternative. It's an or condition, so it is an alternative to basic condition number 2. Where the basic condition number 1 is satisfied, i.e., the person is present in India for more than 182 days. He is considered to be resident in India, and this test applies irrespective of nationality or citizenship. There are certain additional conditions as contained in Section 6.6 which determine whether a person is ordinarily resident or whether he is not ordinarily resident. The two additional conditions are that a person needs to be resident in at least 2 out of the last 10 years. And the second additional condition is his stay in India needs to be for a period of 730 days or more during the last 7 years. If both the additional conditions are met, then the person is resident and ordinarily resident, what we call as ROR. If either of the additional conditions is not met, then he is resident but not ordinarily resident. And if the basic condition itself is not met, then he is considered to be a non-resident. This classification is extremely important, as we'll also see later during the presentation, as based on the residential status, the disclosure norms, taxability of the income differs. We now move on to the second basic condition, which is contained in section 61C. 61C provides that the physical stay in India during the previous year needs to be for a period of 60 days or more, and the stay in India in 4 preceding previous years needs to be for a period of 365 days or more. Again, whenever dealing with NRIs, it is extremely important that their travel history is properly documented, along with reference to the stamps in the passport. We will come later to how do we actually do the counting of the number of days. The additional conditions remain. So even as far as section 61C is concerned, the basic condition is 60 days in the previous year and 365 days or more in the 4 preceding previous periods. And one also needs to test the additional conditions 1 and 2. If both the additional conditions are satisfied along with the basic condition, then a person is considered to be resident and ordinarily resident. If either of the additional conditions are not satisfied, then he is RNOR. And if the basic condition 2 is also not met, i.e., the first condition is not met, and the person is in India for less than 60 days in the previous year, then he is considered to be a non-resident. However, explanation 1 to section 6.1 has certain exceptions. The first exception is it applies to an Indian citizen who leaves India for the purposes of employment outside India, or an Indian citizen who leaves India as a member of the crew of an Indian ship. In such a scenario, what the section provides, or what the explanation 1A provides, is that as far as basic condition number 2 is concerned, the requirement of 60 days is to be read as 182 days. In effect, only basic condition number 1 applies. Moving on, explanation 1B further provides that in case of an Indian citizen or a person of Indian origin who is outside India and decides to come on a visit to India, then again, instead of 60 days, it will be read as 182 days. So this used to be the provision all along. However, the Finance Act has now amended these provisions from AY 21-22 and has inserted an additional condition that such an Indian citizen or a person of Indian origin should not have income other than foreign source income exceeding 15 lakh rupees. So what happens if the Indian citizen or the person of Indian origin has income other than foreign source income exceeding 15 lakh rupees? In such a case, the basic condition 2 is modified to read 120 days. I.e., let us take the example of Mr. NRI who is present in India for 100 days. In this scenario, if his income other than foreign source income, so let us assume that his income from sources in India, let us say he is earning interest income from certain investments which he has made in India, and this interest income exceeds 15 lakh rupees. In this case, given that his presence is more than 120 days, then he would be considered to be a resident. However, he would not be considered to be ordinarily resident. He would be considered as RNOR. He would be considered as a resident, but not ordinarily resident. So be mindful about this amendment, which has come into effect from AY 21-22. Now, the next question which one needs to address is, in counting the number of days, does the stay in India need to be continuous? And second, is the purpose of the stay in India relevant? Generally speaking, if you look at the text of the provisions, there is no reference that the stay needs to be continuous. I.e., even if there are broken periods, they need to be aggregated. Second, if you again look at the text of the section, there is no reference or there is no mention as to the purpose of the stay in India. Section 6(1)(c) simply says that being a citizen of India or a person of Indian origin, PIO, who is outside India comes on a visit to India. Correct. So there is no reference or there is no purpose which is really there. However, while this is the general rule, there is an exception. And the exception happened because of the decision of the Delhi High Court in the case of Suresh Nanda. Essentially, Suresh Nanda was a non-resident for many years. It so happened that because of certain illegal activities which he was involved in, there was a search case and his passport was impounded. On account of the impounding of the passport, he was forced beyond circumstances which were under his control to stay in India. At the time of filing his tax return for the particular period when his passport was impounded, Mr. Nanda actually filed his return excluding the number of days for which the passport was not in his custody. This was obviously challenged by the tax office, and before the courts, it was represented that the legislative provision does not have any mechanism to look into the purpose of the stay in India. Once a person is physically present in India, he should be considered to be resident if the number of days threshold is met. However, Delhi High Court has taken a view that because his stay in India was on account of circumstances beyond his control, and hence it was held that those number of days should be excluded when counting whether or not he is a resident in determining his residential status. However, the court also had a word of caution to say that this should not be treated as a thumb rule, and it would depend on the facts of each case. The second issue which we commonly face whenever we are trying to determine the residential status, especially for NRIs, is how do we count the number of days? Do we include both the day of arrival and the day of departure? Or do we exclude either of the days and we count only one of the days? If we look at international practice, especially the OECD commentaries, because remember, there are a lot of provisions in DTAAs. For example, if you look at Article 15, which deals with taxation of employment income. Typically, taxation rights are again divided where an employee is present for example, more than 90 days in the host, 90 days in the work country, or more than 182 days. So the OECD commentary says that both the days of arrival and departure need to be included, including if a person is visiting for holidays, including days where the person is on leave. What needs to be ignored is only days where a person is transiting from one country to another. However, courts have held a different position. Courts have consistently held that the day of arrival needs to be excluded. This position has been held both by the Mumbai Tribunal as well as the Jaipur Tribunal. One can also draw in support from Section 9 of the General Clauses Act, which provides that whenever any legislation or act requires for the counting of days or provides a timeline for performing or responding to any notice, typically the date of service is excluded. Going from this, inference can also be drawn that the date of arrival should be excluded while counting the number of days. Another peculiar issue which one may face is, imagine a scenario where a person, an NRI, has gone outside India for employment purposes. Let us say he is working in the foreign country for 3 years, 4 years, 5 years, etc., and he has been a non-resident throughout. Now, what happens in the year in which he comes back to India and decides to permanently stay back in India? Would the benefit of explanation 1B, which allows for substituting the 60 days criteria with 182 days, can be availed by such a person? There is an AR decision in the case of Smita Anand, which has held that the benefit in such cases should not be available to an employee who permanently shifts back to India, given that this benefit is simply for people who are outside India and come to India for a visit. The next issue is, what do you mean by the term purposes of employment? Because the benefit is available in case of a citizen of India who leaves India for the purpose of employment. Again, this is a very common situation. For example, can the benefit of this explanation be taken by a person who goes on deputation? Or is it only available if you take a job with a new employer? Can the benefit of this explanation be availed in situation where the person does not actually go for employment, but he goes outside India for setting up his own business? Courts have held that the benefit should also cover instances where a person is deputed by his Indian employer for assignments outside India, even though such assignments may be for a short term, typically for 180 days or for 1 year. Similarly, the Kerala High Court in the case of Abdul Razak has given a wide meaning and a wide interpretation to the term purposes of employment, and has said that it also includes self-employment, like setting up one's own business or profession. Do remember that going out of India on a tourist visa will not suffice to meet, will not be sufficient to avail the benefit of this explanation. You would need a proper work visa. So whenever one is analyzing whether or not benefit can be availed under this explanation, it would also be prudent to check whether or not the client or the assessee has a valid work visa in the country to which he is going. So this covers the basic provisions dealing with residential status for individuals as we have known so far. Again, up till now, if you would see, there was never any emphasis on citizenship for determining the residential status. It was always based on physical presence of the person in India. However, this position has now been changed by the amendment introduced by Finance Act 2020 with effect from AY 21-22. And the amendment is in section 6(1)(a). Let us see the conditions which are there. The purpose of this amendment essentially is to take into account stateless persons. What do we mean by stateless persons? Essentially, there were Indian citizens who were staying in India for less than 120 days, which would mean that they would typically not qualify as a resident. In many instances, they would arrange their affairs in such a manner that they would not be resident in India, including not being resident of the foreign country. typically very common again for the Gulf and other Middle East countries. Now, to tackle this problem, where an individual would not be a resident of either India or in any foreign country, the Finance Act has introduced this concept of deeming such stateless Indian citizens as being resident in India. When do these provisions apply? One, the provision only applies to citizens of India. So it would not apply to foreign nationals. Equally, it would not apply to persons of Indian origin. Second, this section does not apply if you have already met and satisfied the basic test of section 6.1, i.e., if you are already considered to be a resident under 6.1a or under 6.1c, then section 6 capital 1a would not apply. The two conditions are income other than foreign sources income need to exceed 15 lakh rupees, and second, such an Indian citizen is not liable to tax in any other country. In such an instance, such Indian citizens are deemed to be resident but not ordinarily resident in India. The term liable to tax has also been defined in section 229A to mean that there must be income tax liability on the person under the laws of that country. Given this, if you're physically staying in a country wherein there is no income tax, especially many tax havens, in such cases, if you are an Indian citizen and you have income from sources other than foreign sources, essentially income from domestic sources, which exceeds 15 lakh rupees, then you would be deemed to be a citizen of it. Then you would be deemed to be a tax resident as far as income tax is concerned. However, you would not be an ordinary resident. Moving on, having determined the residential status under section 6, one needs to be careful, especially while dealing with non-residents, if they are also residents of some other country or a foreign country. Section 90 of the Income Tax Act empowers the central government to enter into double taxation avoidance agreements. Generally, the purpose of entering into such agreements is grant of relief in case of double taxed income, exchange of information for the prevention of evasion of avoidance of income tax, and also recovery of income tax. Essentially, under this delegated legislation, the central government has the power to enter into DTAAs. What is very important for all of us is section 90 subsection 2. This subsection provides that in case of an assessee to whom said DTAA applies, the provisions of the Act will apply only to the extent they are more beneficial. Given this, it is very important to understand that if we are dealing with non-residents or persons who are residents in more than one countries, one checks whether or not they are tax resident in India under the domestic law under section 6. Second, one needs to examine if they are also resident of some other country. If the answer to either of these questions is yes, then the DTAA comes into play and the benefits under the DTAA would apply. Section 94 and 95 are procedural, which requires that a tax residency certificate to prove or establish that a person is resident in the foreign country is mandatory to claim the benefits under DTAA, and section 95 has prescribed a list of information which, if it is not contained in the TRC, needs to be self-certified and furnished by such assessees, which is commonly known as Form 10F. Another important aspect of any DTAA is generally DTAAs contain what we call distributive rules. The function of these distributive rules is essentially to distribute or divide the taxing rights between the country of residence and the country of source. For example, let us take the case of Mr. X, who is staying or who is a tax resident of United Kingdom. Let us assume that he is also earning some income from India. What one then needs to do is, we need to check whether or not India has entered into a DTAA with UK, which it obviously has. And if the TRC and the Form F is furnished, one needs to examine whether any of the taxing rights which are levied by India can be restricted because of the application of the DTAA. On account of this, it is extremely important to determine where is the person actually resident. Take the example, if let's say such a person, let us take an example of an Indian citizen or an Indian tax resident who is working with a multinational company in India. Let us say that in the month of October or November, for the first time, he leaves India and goes to UK for taking a job. Now, as we all know, India follows a tax year from April to March. And if the person is resident in India or is present in India for more than 182 days, he would be considered to be tax resident under the domestic law. Most of the other countries outside India follow the calendar year, i.e. January to December. So if that person is present in that country from, let's say, November, December and January of the following year, then he would also be considered to be tax resident of that country starting from January. In this case, what happens is that for a portion of the year, for the period January to March, he is considered to be tax resident both in India as well as in the foreign country. In such a scenario, what you have is a person or an individual who is considered to be a resident of both the countries. Another common scenario where this can happen is where one country decides tax residence based on citizenship and another country decides tax residence based on the physical stay in India or based on the physical number of stays in this other country. In such a case, it is quite common that an individual would be considered to be tax resident in both the countries. Typically, all DTAAs have what we call as a tiebreaker rule, which is contained in Article 4.2. This tiebreaker rule essentially provides for a hierarchy of tests which can be applied to determine where is the person actually resident. As you can see, if in case of an individual who is resident in both the countries, the first tiebreaker rule says that he would be considered to be a resident in the country in which he has his permanent home. If he has a permanent home in both the countries or in neither of them, then the second tiebreaker test is where his center of vital interest, i.e. where his personal and economic relations are based out of. The third tiebreaker rule goes about habitual abode, and even then if one is unable to decide, then one needs to look at nationality. And the last alternative is MAB. The reason why deciding this is extremely important is, if you go back, remember that DTAA are structured to distribute the taxing rights between the country of residence and the country of source. One cannot start applying the distributive provisions without first ascertaining where the person is actually resident, whether in country A or in country B. So do remember that if a person is considered to be a domestic tax law resident of both the countries, always remember to apply the tiebreaker rule which is contained in DTAAs. Coming back to our example, wherein a person is considered to be a dual resident, but only for a portion of the year. This happens most typically when a person leaves for employment either to the UK, either to US. UK also has a very similar tax year compared to India, which runs from 6th April to 5th of April. So if we take the example of USA, which has a calendar year, we have the problem where a person would be considered to be a resident as far as the period from January to March is concerned in both the countries. In tax literature, this is commonly known as split residency. What does it mean? It means that the residency or the tax year is split into two parts. So in our example, one would consider that Mr. A is resident in India from April to December, and his worldwide income is taxable in India from April to December. However, from January to March, one may take a position that given that he has left India for good, and given that he is considered now to be permanently tax resident in the other country, one may want to take a position that he is now a non-resident, and hence his salary or employment income for this period of 3 months should not be taxable in India. There have been certain cases which have decided in favor of the taxpayer, but this is a highly litigious position which needs to be adopted after careful consideration of all the facts. The key aspects are: one, there is no legislative basis under the Income Tax Act for the concept of split residency. Second, disclosure in the tax returns is a big challenge, i.e., will you prepare and file the tax return of this person as a resident, or will you prepare and file the tax return as a non-resident? The reason is, if you say this person is a tax resident, then he is considered to be tax resident, at least the way the forms are structured, for the full year, and there is no mechanism or provision to say that after a certain period he is considered to be a non-resident. Second, the income tax forms also do not have a mechanism to disclose if a person is a treaty non-resident. The income tax forms require us to disclose the number of days of presence, physical presence in India, but there is no place or disclosure which one can make if a person is a treaty non-resident. These are obviously practical challenges which one needs to take into account. Moving on to residential status for a company, I'll briefly cover this because again there has been an amendment here in the last couple of years. A company is said to be resident in India if it is an Indian company, essentially any company which is incorporated in India or a domestic company, or its place of effective management in that year is in India. This amendment has been effective since AY 1780. Prior to the amendment, a foreign company was regarded as a resident in India only if the control and management of its affairs was situated wholly in India. However, this position has now changed, and India has also, in line with international practice, put in an additional condition that in case of foreign companies also, if the place of effective management is in India, then such a company would be considered to be tax resident in India. And once a company is considered to be resident, then its worldwide income would be taxable in India. The concept of POEM essentially means it's the place where the key management and the commercial decisions which are necessary for the conduct of business, which are in substance made. This is a term which is very commonly found in DTAAs and on which there is a lot of literature. Further, CBDT has also issued circular number 6 of 2017 and circular number 8 of 2017, which provides extensive guidance on the concept of poem. There is a further de minimis rule which provides that in case of foreign companies whose gross receipts or turnover are up to 50 crores or less, then the concept of poem would not apply. Further, the circular in fact looks at the concept of poem from the prism of whether or not such a foreign company is engaged in active business or not. I.e., it provides that if a company is engaged in active business and the passive income is less than 50% along with some additional conditions, then there is a presumption that such a foreign company does not have its poem in India, provided the key management, commercial decisions and the board meetings are not held in India. However, if you are dealing with companies who have only passive income or where the passive income is more than 50%, then the circular provides that one would then have to examine all the facts of the case. There is also a view that the test, the additional test of passive and active business test, which are provided for in the circular, they go beyond what is provided in section 6, and whether the circular is ultra vires the provisions of what is provided for in section 6. Similar to companies, remember there is a similar to individuals, there is also a tiebreaker rule test which is typically included in all DTAAs. If we look at the OECD model DTAA, Article 4.3 contains an tiebreaker rule for persons other than individuals. So this would apply to companies. If you see, there are two versions of Article 4.3. The reason for this is the OECD model convention after 2017, on account of the suggestions which were made as part of the base erosion program. The BPS, the base erosion and profit shifting recommendations, has now a new version of Article 4.3. But remember, we should not be solely be influenced by what is contained in the OECD model convention, and one would always have to take a look at the actual DTAAs, because unless the actual DTAA is modified on account of either a change in the treaty by way of a protocol or entering into a new treaty, or because of an MLI which comes into force, the old provisions would continue to apply. The old provisions simply provide that where a company would be considered to be a resident of both the contracting states, then in such cases, it would be deemed to be a resident only of the state in which its place of effective management is situated. So take the example of a foreign company which is incorporated, for example, in UK. However, let us assume that all the shareholders and all the board of directors are actually physically present in India. All the control, management and the decision making is happening in India. In such a case, under India's domestic law, such a foreign company would be considered to be tax resident. Obviously, from a UK tax perspective also, they have a formal incorporation test wherein any company which is incorporated in the UK is also considered to be a tax resident in the UK. Hence, in such a scenario, one would then need to take recourse to the tiebreaker rule which would be contained in the India-UK DTAA. Let us now look at the change in wording which is contained in the new clause of Article 4.3. Here it provides that where a person is considered to be a resident of both the contracting states, it is the competent authorities who will determine where this person is resident for the purposes of the DTAA, and in the absence of such an agreement, the DTAA would not apply. What this would then mean is that if we are dealing with dual resident persons and you are dealing with a new Article 4.3, unless the competent authorities come to a determination where such a company is tax resident, you would not be able to take benefits of the DTAA, and such a company would be taxed in both the contracting states. Having determined the residential status, the next thing which one needs to do is look at section 5, which talks about the scope of taxation of income. As we know, if our determination is that you are a resident, then the worldwide income is taxable, whether it is income received or deemed to be received in India, whether the income accrues or arises or is deemed to accrue or arise in India, and or whether or not it is income which accrues or arises outside India. In case of non-residents, any income which accrues or arises outside India, including income which is derived from a business controlled in or a profession set up in India, would also be not taxable as far as non-residents are concerned. So remember, section 6, determine the residential status. Go back to section 5, which deals with the scope of taxation of income. Having determined whether a person is a resident or a non-resident, the next thing would be to take into account the tax rate. As far as individuals are concerned, the tax rates for resident individuals and non-resident individuals are similar, i.e., there is no difference. However, do note of some minor differences. One is the rebate under section 87A is not applicable to non-residents. Further, in recent years, a beneficial slab rate is introduced for senior citizens who are residents and also super senior citizens. So these are essentially resident individuals in the age bracket of 60 to 80 years and in the age bracket of 80 and above. This benefit is not applicable in the case of non-residents. As far as surcharge is concerned, again, remember that the surcharge is similar whether you are a resident individual or a non-resident. However, as far as dividend income and capital gains is concerned, the rate of surcharge is capped at a maximum of 15%. For firms and LLPs, the tax rate is 30%, again similar to whether you are a resident or non-resident. As far as foreign companies are concerned, including the branches, the basic tax rate is 40%. Non-resident individuals can also opt for the optional tax regime of 115 BAC. Again, provisions are similar whether you are a resident or a non-resident. Section 10. When we are dealing with non-residents, also one of the most common items of income which we come across is typically interest earned on NRE accounts or deposits. Remember, there is a specific exemption which is contained in section 10.4.2, which applies to such interest income. Again, there are further exemptions as far as interest income earned by non-residents on FCNR deposits, which is contained in section 10.15 subclause 4 FA, and if the interest is earned by a non-resident from deposits which are placed with an offshore banking unit or from a unit which is located in IFSC. Further, if we are dealing with foreign nationals who come to India on what is commonly known for a short deputation, not exceeding 90 days, then there is an exemption which is contained in section 10.6. What does it provide? It provides that in case of an individual who is not a citizen of India and any remuneration which is received by him as an employee of a foreign enterprise for services which are rendered by him during his stay in India would be exempt, subject to certain additional conditions which are contained therein. One may note that while this exemption is there in section 10(6), most DTAAs which India would have entered into also contain similar exemption in Article 15, which deals with taxation of employment income, wherein either a 90-day or a 182 days threshold is prevalent, beyond which only the employment income of such a foreign citizen would then be taxed in India. Now, having determined the residential status and the scope of total income, let us look at some of the specific provisions which one needs to take care about as far as filing of income tax returns for non-residents. One of the most common questions which one encounters is a tax return compulsorily need to be filed for a foreign company or for a non-resident Indian? Let us understand the implications of this by way of an example. FCO has received royalty from its wholly owned subsidiary ICAI in India during financial year 21-22. The Indian company has deducted TDS under section 195 at 20% plus applicable surcharge and cess. The question with the foreign company has asked you now is whether or not it is obligated to file income tax return, and does it also need to submit transfer pricing audit report in form 3CEB. There could be different variations to this question. One is that this income, the royalty or fees for technical services, is completely exempt under DTAA. So while there is a 20% tax rate under domestic law, when one examines the DTA, this income is completely exempt. Let us imagine if the Indian company has not done any withholding because of the applicability of the DTAA. So would your answer change if based on the DTAA, the income is not taxable in India? There could be a third variant. The DTAA, instead of 20%, provides for a capping wherein it says that royalty can only be taxed up to a maximum of 10%. And hence, as per the provisions of the applicable DTAA, the tax has been deducted at 10%. So in practice, all three scenarios are commonly faced by our clients. And the question to you then would be, is the foreign company required to obtain the PAN and file its income tax return in India? Let us take a look at the provisions of 139(1). As per 139(1), a company or a firm, it is mandatory to file an income tax return if you are a company or a firm. In case of any other person, essentially we would be concerned about individuals, there is a requirement to file the tax return only if the income exceeds the basic exemption limit, which is 2.5 lakhs. Do note that the definition of company also includes a foreign company. Given this, there are two views which are possible. One, the wording of section 139(1) does not say that a company or a firm is required to file the return only if the income exceeds a certain threshold. Given this, even when such a company has nil income or where the income is not taxable in view of the DTAA, it is mandatory to file the tax return in India. The second view is, if the income is exempt either under section 10 or because of the provisions or the applicability of the DTAA, in such a scenario, it should not be required for the foreign company to file its income tax return in India. there are case laws on both sides of the table. And the better view seems to be that if the income is chargeable to tax under the domestic tax law, even though it may be exempt under the DTAA, it is mandatory to file the return of income. And the reason why courts have held that this requirement is mandatory is because it provides an opportunity to the tax office to examine the claim of the taxpayer, i.e., that it is indeed a tax resident of the foreign country. Second, that the income is indeed exempt because of the application of the DTAA. Where such a tax return itself is not filed, then there is no scope or there is no mechanism by which the tax office can actually examine the claim that such income is exempt. And hence the better view seems to be that one should file the tax return. The position, this was the position all along. However, there has been an amendment in section 115A, subsection 5. Let us take a look. What does this provide? It provides that it shall not be necessary for an assessee referred to in subsection 1, essentially it deals with non-residents, to furnish return of income under section 139(1) if his total income is assessable under this act and the tax deductible at source under the provisions of Part B of Chapter 17 has been deducted from such income and the rate of such deduction is not less than the rate specified under this section. Essentially, what 115A5 has done is, if in case of a foreign company or a non-resident, where TDS is deducted at the rates which are prescribed under this section. For example, dividends are taxable at the rate of 20% plus applicable surcharge and cess. Interest is usually taxable at 20% with certain exceptions. Royalties and fees for technical services is taxable at 10%. If tax has been deducted at these rates without having recourse to the DTAA, which may prescribe a lower rate, either 5% in case of royalties, fees for technical services, or a nil rate.
Mohit, can you put yourself on mute, please?
Thank you. So in such scenarios, only i.e. where the TDS Am I audible?
Yeah, yes, sir. Yes, sir. I had to mute all because there was a disturbance in the audio. Please continue.
Is the screen visible?
Yes, yes. Please continue.
Okay. Okay. So section 115A5 specifically provides that there is no requirement to file the tax return only in cases that the withholding has happened at the rates which are prescribed in this section, and to the extent the withholding has happened at a lower rate on account of the application of the DTAAs. In such cases, now it is mandatory to file the tax return. This was not always the position. Let us look at the wording of section 115A5 before the amendment. Before the amendment, it simply said that it shall not be necessary for an assessee to file the return if the tax has been deducted under the provisions of Chapter 17B. And the reference to Chapter 17B also included rates in force. If one looks at the definition of rates in force, which is contained in section 2, it has a reference both to the tax rates as applicable under the Finance Act and also section 90 in case of DTAAs have been entered into, which would hence the interpretation all along was as long as withholding has been applied as per the DTAA, then the position before the amendment of Finance Act 2020 was that there was no requirement for furnishing of the income tax return. However, all this is now academic, and after the amendment which has been brought about by Finance Act 2020, if the benefit of DTAA is availed, then it will be compulsory to file the return. Second, the scope initially was limited to incomes which were referred to in Clause A, and Clause A only dealt with dividends and interest income. The scope of 115A5 has now been extended to cover also royalty and fees for technical services. So this is a beneficial expansion of the scope of 115A5. The next question is, let us say, because of the applicability of 115A5, wherein withholding has applied at the rate of 20%, for example, we are dealing with dividends or interest, or at the rate of 10% when we are dealing with royalties and fees for technical services, and there is no requirement to file the tax return. Can one take a view that no transfer pricing audit report needs to be filed in Form 3CB? Unfortunately, no. If you look at the text of section 92E, it says every person who has entered into an international transaction shall obtain a report from an accountant and furnish such report. The text is very clear. Every person, it includes both residents as well as non-residents, and the international transaction would be receipt of royalty from the wholly owned subsidiary or the associated enterprise in India, or receipt of fees for technical services from the associated enterprise in India. Remember, there are certain penalties for non-furnishing of the audit report in Form 3CB. Hence, on a conservative basis, when one is advising our clients, one should always ensure compliance with the provisions of section 92E to ensure that the penalty provisions don't follow. Moving on, let us look at some of the specific issues which one needs to be aware about when one is dealing with capital gains and non-residents. Section 9, as we are all aware, deals with the incomes which are deemed to accrue or arise in India. In the context of capital gains, this would include income which arises on account of transfer, whether directly or indirectly, of capital assets which are situated in India. The charging provision is contained in section 45 of the Income Tax Act, and the computation mechanism is contained in section 48. As far as the rate of tax is concerned, the three relevant provisions are section, my apologies, it should be 111A and not 11A, section 112 and section 112A. We are already aware the period of holding is provided for in section 242A and 229AA of the Income Tax Act. Let us take a look now at the mode of computation which is prescribed in section 48. As we are all aware, one needs to determine the full value of consideration. From this, one is able to deduct the cost of acquisition, the cost of improvement, and any expenses which are incurred wholly and exclusively for the transfer of a capital asset. Following this, any exemptions, or especially for reinvestment, can be availed. This is common whether we are dealing with non-residents, or residents. However, one needs to give effect to the wording of the first and the second proviso to section 48. Let us look at the first proviso to section 48. The first proviso to section 48 says that provided in the case of an assessee who is a non-resident, capital gains which arise from the transfer of a capital asset being shares or debentures of an Indian company which have been originally been acquired in a foreign currency, they need to be computed by converting the cost of acquisition, the sale consideration, also in the foreign currency in which it was utilized for the initial purchase. What does this mean? It means that, let us take the example that a foreign company has subscribed to the shares or has incorporated a wholly owned subsidiary in India, essentially a 100% FDI case. In such case, because the original acquisition of the securities is in foreign currency, at the time of transfer of such shares, the computation would first need to be done in the foreign currency, and then the gains would have to be reconverted back into INR. Couple of points. The first proviso only applies to non-residents. Hence, it would never apply to residents. Second, it applies only in cases of shares and debentures of an Indian company. It doesn't matter whether listed or not listed. The rule which supports the first proviso is contained in 115A. Some other remarks. The second proviso to section 48 deals with the indexation benefit. Remember, the cost of acquisition and the cost of improvement in cases of transfer of a long-term capital asset, one is entitled to the index cost of acquisition and also entitled to claim deduction for the index cost of improvement. So the second proviso, which deals with the indexation benefit, does not apply in cases where the transfer is covered by the first proviso. Second, third proviso explicitly clarifies that both the first proviso, i.e. the foreign currency conversion benefit, and the second proviso, which is the benefit of indexation, both of these do not apply if we are dealing with cases covered by section 112A. Section 112A, as one would know, deals with long-term capital gains in case of listed shares, essentially equity shares and equity-oriented mutual funds on which STT is paid on their transfer. Let us examine what Rule 115A specifies as far as the first proviso is concerned. It says that the cost of acquisition needs to be converted into the applicable, based on the applicable foreign exchange rate, being the average of the telegraphic transfer buying rate and the telegraphic transfer selling rate on the date of acquisition. Second, any expenditure or full value of consideration, if it is in INR, also needs to be converted based on the average of the telegraphic transfer buying rate and telegraphic transfer selling rate on the date of transfer. After computing the capital gains in the foreign currency, one needs to reconvert those gains into INR based on the telegraphic transfer buying rate as applicable on the date of the transfer. The reason for this is, if the capital gains are computed or calculated in the foreign currency, it eliminates the effect of any adverse depreciation or appreciation in the foreign currency. I.e., let us understand this by way of a practical example. Let us say that FO has subscribed to 10,000 shares of ICO of face value 10 each on 1st of January 2000. Correct? So based on this, let us say that it incorporated a company with a cost of INR 1 lakh. As we all know that it would have need to remit amount in foreign currency as and when this original investment is made. Let us assume that the USD to INR rate was 49, which would mean that approximately USD 2041 was remitted to India. On 10th March, FCO decides to sell the shares of ICO to a non-resident for USD 20,000. So far, so good. Now the question is, how do we compute the capital gains which arise in this case? Remember, the first proviso is very clear. It applies in cases where capital gains are earned by non-resident and if one is dealing with transfer of shares or debentures of an Indian company. What would one need to do? 1. Determine the sale consideration. The sale consideration is already available in the foreign currency. Rule 115A would only require us to convert it into foreign currency if it was available in INR. As we know, the shares have been sold for USD 20,000. From this, we are entitled to deduct the cost of acquisition. We know that the original investment was for an amount of 100,000 or 1 lakh. And yes, Jiten bhai.
Siddharth, CCM sir has actually joined.
Okay, should we?
Just a moment. I'm just, sir, Sanjay sir, I hope you are there.
Yes, sir. Yeah. Good afternoon. I'm here.
Yeah.
No, you can continue. I can deal in the last also. There is no problem.
Sir, in case sir, you are willing to stay, we'll be more than happy. In case you have any exigencies or something to say move around, so please sir, you can address the gathering right away.
Sir, it would be an honor to hear you, and I'll continue post that.
Yeah, thank you, Siddharth. I'll continue to be there, but you know the advantage of the technology. I'm enjoying that today. Instead of coming to Nagpur, I'm addressing through this to all of you and feeling the same touch, you can say. So thank you for giving the time. I'll just say one thing and then I'll stay back. And if possible, till end, I'll listen you. You are deliberating very well. So I'm thankful to the Nagpur branch for doing international taxation with the topic on VCM on international taxation. With the International Tax Committee of the ICAI. The chairman of the Nagpur branch is very dynamic and is holding a lot of activities. I've been briefed. So I'm thankful to CA Jitendra Saglani ji, chairperson of the Nagpur branch. And then my own name, Sanjay M. Agrawal, vice chairman of the branch. So I'll try to see this, that in this year I come in Nagpur and meet him. My synonymous also, the secretary Akshay ji and the treasurer ji Dinesh Rathi ji and RCM if he is not there in absentia, Abhijit ji. And then I've been told that past chairman Mr. Agrawal ji is also there. So thank you to all of you. The topic which you have touched, in fact, is very near to me also. And you see, a lot of mistakes we are doing in the filing of the return of the NRI, especially the conversion which Siddharth, you were talking about. It's very sensitive. And sometimes member doesn't know how to take the buying rate, SBI TT rate, etc. So all these are very important. And when you calculate the exchange conversion which will be lost, if suppose there is a increase in the currency, then the investor has to pay the tax on it, because the increase will not be there in the, though if he is a domestic taxpayer, then he is getting the benefit, but if he is not the domestic taxpayer, then he is not getting the benefit if the currency improves. So what I say that explaining the topic just as if somebody is calculating step by step, and that is something the beauty of the speaker. That's all I would like to say, and I wish good luck to Nagpur branch for doing the excellent activities. Continue to remain with us. There is no stoppage on the physical or your VCM. You can hold as many as VCM you want. And I see the Siddharth, you say that deliberating very good. And I'm sorry that I could not join at 11, because yesterday when the president was leaving, he has given me some task, and which I have to do it in the morning. And I have a hearing in the morning also in the ITAT just Friday bench. So that got delayed. So I'm extremely sorry that I have not been able to join you in the beginning. And I'm there and listening you. You may continue. Thank you very much, Chairman, for giving me the opportunity. And Siddharth, I'm extremely sorry that I'm.
Sir, thank you for your
kind
words and words of encouragement and support.
Sir,
we all learn from seniors in the profession, and it is only on account of learning by attending many of the seminars with WRC and ICAI have been regularly conducting. That we have benefited and learned over the years, sir.
Yeah. When I started in 98 for the first time and I spoke, I was shivering like anything on the stage, though I was a good orator in my college time. So the addressing the member is one of the difficult tasks. Handling their queries is one of the difficult tasks. And the last one is this, that you come down to the member itself. Because today we are not here to tell what we know, because a lot of knowledge is there. But today we are here to tell the member that what we should tell them, so what they want. So this is something when you come down to their level and explain them to them, then you enjoy the seminar. So it should be, though it is a VCM, but it should be, you can say, two-way. We continue to interact with the member either through chat box or through, you can say, unmuting them. So I should, when the members involved, then you enjoy. Like in a cashier, I always say that if end of the day your cash is tally, it means your day is good. If your cash is not tally, so with the speaker also, if the queries are solved, then it means his cash is tally. So
sir, definitely I'll keep the last 10 minutes for Q&A and address all many of the, I've seen many of the questions are there in the chat box. I'll be happy.
So
happy to
do take care. Not even 10 minutes, even if your topic is left, you can circulate your PPT, but the query should be taken. And that's what I always, when I address any gathering, I order. So not taking much of time, please continue. Thank you very much.
Thank you so much, Chairman, sir.
Yeah, just a moment. Actually, sir, we didn't have the privilege to introduce you, but we just wish to convey to the audience that CA Sanjay Kumar Agrawal ji has been a central council member since 2010, and he has been serving the profession for such a long period. So thank you so much, sir, for joining today and gracing the occasion. And I wish to thank the Vice Chairman of this committee as well, CA Cotha Srinivas ji, because he also has been instrumental in helping us in organizing this program. And thanks to the entire committee, the Committee on International Taxation, for helping us to organize this program. With these words, I again hand it over to Siddharth and Ajay. Kindly take this forward.
Yeah, so that's why you can please directly continue.
Sure. Thank you. Are the slides visible now?
Yes, it is visible.
Thank you. So coming back to our example again, so this is how the computation of capital gains would work in the case of Rule 115A, wherein both the sale consideration as well as the cost of acquisition first needs to be converted into the foreign currency, which was utilized for the purchase of shares. Having arrived at the capital gains which have been computed in the foreign currency, one needs to reconvert it back into INR. Be very careful, as sir was just mentioning, where to use SBI telegraphic transfer buying rate, where to use the average rate. The rule is very specific. So one needs to be quite mindful and careful when doing the computation where the original investment has happened in the foreign currency. There is an additional point here, and not always relevant to non-residents, but I would like to cover this also. And this would be instances where what happens is, which is Rule 115, which is a general rule. Now, this rule actually deals with conversion of any foreign income or any income which arises to the assessee in foreign currency. But obviously, the income tax return and the computation needs to be done in INR. The key points about this rule is Rule 115 provides that as far as income which is chargeable under the head capital gains is concerned, it needs to be translated back into INR based on the SBI telegraphic transfer buying rate based on the last day of the month immediately preceding the month in which the capital asset is transferred. Remember, this is a general rule. So a specific rule will always override the general rule. Second, this rule applies in cases of both residents as well as non-residents. Hence, the applicability of this would be more where a resident person has invested in foreign securities or foreign shares. Quite common these days, where many of our clients come to us saying that we have made investments in US stocks. Correct. And be mindful that there is no specific bar on indexation benefit, which is again applicable here. Moving after this, I would like to, and also keeping in mind the time, I think I would like to cover some of the very specific provisions which are applicable to NRIs in particular. And these provisions are covered in section 115D onwards. They deal with taxation or the rates of tax for investment income and on long-term capital gains for NRI specifically. Okay. Let us first look at some of the key definitions which are contained in this section. Investment income would mean any income which is derived from a foreign exchange asset, essentially which has been defined to mean an asset which has been acquired by the assessee in convertible foreign exchange. An NRI has been specifically defined as an individual being a citizen of India or a person of Indian origin who is not a resident. Essentially, the person continues to hold Indian passport, or he is a PIO, i.e. that either of his parents were born in India or his grandparents were born in India. This section only applies in case of specified assets, which is essentially shares in an Indian company and debentures which are issued by an Indian company, not being a private company. The benefit really is that investment income is taxed at the rate of 20%. From a practical perspective, there used to be a non-resident, non-repatriable scheme wherein NRIs were encouraged to hold foreign currency deposits in India. Under this scheme, again, courts have held that the benefit of 20%, if you recollect, otherwise the taxation would happen at the applicable tax rate as far as interest income is concerned. Here it would be capped at 20%. Courts have also held that even interest earned on NRO deposits which have been made from convertible foreign exchange will also be taxable or treated as investment income, and the concessional rate of 20% would apply. The section also has grandfathering benefits or reinvestment benefits where the capital gains are not taxed if the gains are again reinvested under this section. There are certain machinery provisions which deal with when filing of returns are not required. Again, the scope is very limited because only if you are earning investment income or income from long-term capital gains as specified under these provisions. There is also an option for NRIs who become resident subsequently to continue benefiting from the provisions even after they have become resident, and for this an application needs to be made. As I started at the beginning, the universe is really big. It is almost impossible to cover in detail all the applicable provisions. What we have tried to do is cover residential status and some of the more specific provisions in terms of section 115A and capital gains as far as non-residents are concerned. What I am unfortunately unable to cover is some of the more specific provisions which deal with business income taxation for non-residents. However, this deal with very specific scenarios, either operations of ships or aircrafts. However, in my presentation, which I'll be circulating later, I've made a reference. So if in practice you are dealing with any of these companies, you can take recourse to the applicable sections. Now let us move to some of the more practical aspects as far as filing of tax return is concerned. The first question which my team members, when they were helping me with this presentation, asked me is, sir, which IT return is actually applicable? If we are dealing with non-residents. It has been a great learning because it was an opportunity to go back to some of the instructions and guidelines also which are released along with the tax return. So remember, if we are dealing with non-residents or individuals which are resident or not ordinarily resident, ITR 1 and ITR 4 would not apply. So if you are dealing with non-resident individuals who have income from business or profession, then ITR 3 would apply, and in other cases it would be ITR 2. As far as companies is concerned, we have a common form ITR 6, and for persons other than companies, whether residents or non-residents, it would be ITR 5. So be mindful that ITR 1 and ITR 4 would not apply to non-residents and residents who are not ordinarily residents. Disclosures. What I've tried to do here is provide a screenshot of the residential status disclosure requirement which is applicable for individuals. Extreme care needs to be taken in selecting the correct option. So please do determine after going through in detail the rules of section 6, whether we are dealing with a resident, whether we are dealing with a resident but not ordinarily resident. And if you are not ordinarily resident, it is on which account, or you are dealing with non-residents. Additional disclosures which apply if you say that you are a non-resident, you are compulsorily required to disclose your jurisdiction of tax residence and also your tax identification number in the foreign country. If you are an Indian citizen or a person of Indian origin, You also need to disclose the period of stay in India during the previous year, as well as the 4 preceding previous years. My only concern or the practical challenge herein, which one always faces when one is computing this, is imagine a scenario where you are a treaty non-resident, i.e., you are resident in India for, let's say, more than 60 days. However, because of the application of the DTAA, you are a treaty non-resident. Then, when you're filling the number of days of stay in India, and if you input more than 60 days, which is mandatory and which is also required, the tax office may misinterpret the facts and may serve you a notice, because they may have no chance to understand that you are a non-resident on account of the application of the DTAA. However, again, these are practical challenges which one needs to take into account. Very rarely, if the tax identification number is not available, it will always be available. In the US, it is the social security number. For UK, you have a tax reference number. In those instances, in practice, we end up disclosing the passport number instead of the TIN. Second, whether scheduled asset liability disclosure would be applicable if you are filing a tax return for non-resident individuals or for individuals who are resident but not ordinarily resident. And the answer is no. The instructions or the guidelines make it amply clear that in case where the total income exceeds 50 lakhs, this schedule is only mandatory as far as residents are concerned. And in case of non-residents and RNOR, what you need to disclose is only your Indian assets. Your foreign assets need not be disclosed as far as non-residents and residents but not ordinarily residents are concerned. Another mistake which we commonly come across, which is done, is imagine a scenario where a foreign national is deputed in India. Typically, this happens a lot in multinational groups. You would have the CEO or the CFO being deputed from the overseas jurisdiction. In such cases, such deputation is typically for a period of 3 years. If such a person becomes a resident and ordinarily resident, especially after the 3rd or the 4th year, please remember that under this schedule, you need to disclose all your assets and liabilities here. Many a times what happens with foreign nationals is we do not ask them enough information about if they have received or earned any income outside India, or if they own any assets outside India, and hence then we fail in our duty of completing the disclosures here. However, as I said, if it's a non-resident or RNOR, it would not apply. Details of exempt income. If any income is exempt under the DTAA, remember our case where a position is adopted, where on account of split residency, you are taking a position that certain employment income for a period is not taxable in India. Or let us say because of the application of the DTAA, a particular income is not taxable in India, then it needs to be disclosed under the exempt income schedule, because this is the only way or the mechanism by which the tax office comes to know that you have availed the treaty benefits and the income is not taxable in India because of the application of the DTAA. Again, one may actually question whether income which is exempt under DTAA, is it actually exempt? Correct, because our understanding of exempt income is generally incomes which are exempt under section 10, correct, and we don't even come into or enter into the computation of income. However, in our experience, it is better to be upfront and be conservative as far as our disclosures are concerned, to avoid misinterpretation or avoid the risk of non-disclosure or incorrect disclosure while filing of tax returns. The next question which commonly is asked is whether schedule FSI, schedule TR and FA, whether the foreign source income schedule, the tax relief schedule and the foreign assets schedule, is it applicable when we are filing tax returns for non-residents or for RNOR? And the answer to that is no. It only applies when we are filing of tax returns for residents. Again, these days, a lot of residents are also earning income from sources outside India. Remember, in such cases, please do not forget to duly report such foreign source income in Schedule FSI. Also, please note that this is in addition to the disclosure which would already have been made or which would already have been input in the headwise computation. So for example, let us say that one is earning interest, or a resident individual is earning interest or dividend from outside India. While one needs to disclose this under income from other sources, in addition to the disclosure, because that would then flow into the computation of total income, one needs to also disclose this in the FSI schedule. So it is an additional disclosure which sometimes people miss out on in the wrong interpretation or the wrong misconception that given that they have already disclosed this in the income from other sources schedule and it has been taken into account in the computation, there is no requirement to again disclose this in FSI. Please do not make this mistake. Schedule TR tax relief. Now, the concept of foreign tax credit again is only relevant in the case of residents. Remember our original discussion which we were doing as far as the application of section 90 and 92. In that case, if you recollect, the role of DTAAs is to distribute the taxing rights between the country of residence and the country of source. If a person is a non-resident and such a non-resident individual or a foreign company suffers tax in India, being the country of source, then any tax relief on such income would be available to them in the country in which they are considered to be tax resident, i.e. not in India. Let us consider the reverse scenario. If you are filing returns for a resident who has earned income from foreign sources, and such a resident has also suffered withholding of tax in the foreign country, either on dividend income which they have earned, or on royalty or fees for technical services in the foreign country. Only in such scenario, because you are a resident of India and India would have entered into a DTAA and with that other country, then one is entitled to claim foreign tax relief by filling up Schedule TR. Also do remember that Form 67 needs to be filed before filing of the ITR. Form 67 is nothing but where one needs to disclose the source by source foreign income which has been earned by the tax resident and what is the foreign tax which has been suffered in the foreign country and on which relief is claimed. In case of unilateral relief, it would be section 91. Similar to above, again, the schedule of foreign assets only applies in case of residence and it need not be filled up if you are filing a tax return for non-residents and residents but not ordinarily residents. However, if you are dealing with residents, please be very careful these days because there is a lot of penalty for non-disclosure under the Black Money Act, which can run up to 10 lakh rupees for non-disclosure of your foreign assets and liabilities in Schedule FA. So please be very careful. These days, a lot of our clients are investing in foreign assets. This could be shares and securities in foreign countries. Many of our clients who are working in MNCs, typically they receive employee stock options of the ultimate parent, which is listed on a foreign stock exchange, typically in the US. In all those cases, please be very mindful to disclose whatever foreign assets are earned. Another common scenario is NRIs who have relocated permanently back to India. They are permitted to continue holding their foreign bank accounts and their foreign immovable properties even after shifting back to India. Once those NRIs become resident, as far as income tax is concerned, in those cases also be mindful that Schedule FA would be applicable, and do not forget to make the appropriate disclosures. I think just before we started our presentation today, it was being remarked, Ajay ji was remarking that a lot of notices are being issued to many non-residents, especially in scenarios where Schedule FA has not been filled up. Of course, for a non-resident, Schedule FA does not apply. However, if you have become a resident, it is critical that this schedule is correctly filled. I think one of the last concluding points which I would quickly like to cover and then take on questions is Section 195. So if we are dealing with our clients who are non-resident individuals or foreign companies, and even if we are dealing with resident companies who wish to make payments to non-residents outside India, please be careful that withholding tax or TDS is applicable under Section 195. The basic provision of the rule is contained in Section 195(1), which casts an obligation on any person who is responsible for paying to a non-resident or to a foreign company any sum which is chargeable under the provisions of this Act, and the rate of TDS is based on the rates in force. The scope of any person, it has been clarified by way of an explanation that it covers both residents as well as non-residents. Again, the withholding only applies if the payment has an embedded element of income and there is something which is chargeable to tax under the Act. If the payment has no element of income, then Section 195 does not apply. Coming very quickly to the rate at which TDS needs to be done. Unlike the domestic law, where under 194J we have the rate of 10%, or for 194C we have the rates of 1 or 2%. As far as Section 195 is concerned, TDS needs to be deducted at the rates in force. Rates in force has been defined to mean rates as specified under the Finance Act, or the rates as per the DTAA entered into by the government. Given this, if the DTAA is applicable, remember one needs to have the TRC and the Form 10F in place, then it is perfectly fine to deduct or do the withholding at the lower rate applicable in the DTAA. Another common question in practice which one needs to deal with is the applicability of 206AA. Of course, 206AA applies both at the time of withholding for domestic as well as payments made to non-resident pays also. Now, 206AA provides that a higher rate of withholding of 20% should be applied if the payee fails to furnish the PAN. After the introduction of this section, and I think it's been almost over a decade, the department started taking a view that in case of payments made to non-residents, even though the treaty would provide for a lower rate, typically 15%, 10%, and sometimes nil. If the PAN was not furnished, they started sending notices for default in compliance with the provisions of Section 195 because of the applicability of 206AA. However, there are a plethora of judgments, and it is a settled law that the provisions of Section 206AA cannot be invoked to frustrate the benefit of Section 92, wherein a lower rate has been agreed under the tax treaty. And we have multiple decisions of the courts which have taken this stand. Of course, following this, there was also an amendment to Section 206AA, where they have clarified that the provisions of 206AA would not apply in respect of payments of the nature of interest, royalty, fees for technical services, dividends, and transfer of capital assets. So essentially covering majority all the applicable payments. If the deductee furnished the details and documents which are specified in Rule 37 BC, and essentially this would be equivalent to the TRC and the Form 10F, wherein, where the person is a tax resident, the tax identification number, his address, contact details, etc., are self-certified and kept on record. Another two provisions or sections which are commonly dealt with in practice is where the payer can make an application to determine the portion of payment on which deduction of TDS needs to be done under 195(1). So this is essentially where most frequently, let us say that there is a sale of immovable property, and only the entire sale proceeds is not income. Then the payer can very well make an application under 195(2), and thankfully now there is a rule and form which has been prescribed under which the application can be made by the payer. Equally, the law has a provision where the payee can also make an application, i.e. where the payee does not want to go through the hassle, and the payee can make an application. Most commonly for lower deduction certificate, an application is made under Section 197(1) in Form 13. And again, reference is given to the various rules. Again, this application, similar to Form 15E, needs to be made electronically and online, unlike previously where a physical application had to be made to the TDS officer for obtaining the lower deduction tax certificate. Also remember, whenever payments are made under Section 195, Subsection 6 read with Rule 37 BB contains or requires that Form 15CA should be furnished. If you examine Rule 37 BB, it has an exhaustive list of payments on which for which no such Form 15CA and 15CB are required, most commonly import of goods. And again, there is an exhaustive list contained therein. Many a times in practice, what we have realized that bankers are not aware about this exception which is contained in the rule, and they simply unnecessarily ask for Form 15CA and 15CB. So before you go ahead and issue a Form 15CA CB, first do verify whether there is an exemption already in place contained in the rule. If you are not covered by the list of payments for which Form 15CA CB is not required, then obviously feel free to issue Form 15CB after examining the applicability of the treaty, and Part C of Form 15CA would need to be filled. So I think with this, I would like to call a close to the slides. I know it has been a bit hurried, but I hope that we have covered some of the most basic aspects and the care which needs to be taken in determining the residential status for non-residents, some of the applicable provisions in computing the capital gains, and also the care which needs to be taken while filing of the tax returns. With this, Ajayji, back to you, and I'll be happy to answer some of the questions which are there.
Thank you so much, sir. It was an excellent deliberation, and I personally too enjoyed hearing to you. So yeah, it's the time to take the question and answers from the members. First, we'll cover the questions that have been covered in the chat box, and then we'll take up on the Zoom platform.
Sure.
So there is a question like, what about the tax rate for selling of a property long-term capital gain?
It would be 20%. So I will just a second, if I can share my screen. Sorry, I probably.
Yeah, we can see us still.
So is the screen visible?
Yeah.
So essentially, as I mentioned previously, the relevant provisions are contained, or the tax rates are contained in 111A. If we are dealing with equity shares, unit of equity oriented mutual fund, on which STT has been paid, the tax rate is 15%. Again, it's similar for residents or non-residents. In all other cases, the taxation would be on the applicable slab rate. This is also similar whether we are dealing with residents or non-residents. As far as long-term capital gains are concerned, the relevant provisions are contained in section 112 and 112A. If we are dealing with equity shares and units of equity oriented mutual funds on which STT has been paid, remember that now long-term capital gains on equity shares are no longer exempt as before. However, the de minimis of there being no long-term capital gains up to a sum of 1 lakh rupees applies to both, whether you are a resident or you are a non-resident. In all other cases, the tax rate is governed by section 112. As far as immovable property, the general rule again, which is contained in section 112, is the tax rate on long-term capital gains is 20% with indexation. There is a proviso in section 112 1C2, which provides that at the option of the taxpayer, the lower rate of 10% applies, provided the benefit of indexation is not available. So hopefully the presentation will be circulated after this, which should answer the question.
Correct. I will take another question. If a person becomes non-resident, then the investment and or properties which she had acquired while he was a resident, how the same will be treated? Will this holding be considered as a holding of an NRI?
So the question is, a person is a resident, correct?
So he had acquired assets while he was a resident and then became a non-resident Indian. So what would be the status of the investments he has done? Would the assets be called as NRI assets?
Definitely not. See, because if you look at the provisions again, I think the question is, I'll first answer and then put on the slides. So the specific provisions which are covered in section 115E and onwards, those only apply if the investment is made in freely convertible foreign currency, right? Whereas the question which has been asked is, we are talking about a person who has been a resident in India, and such a person, let us say after a few years, he has some investment in shares, mutual funds, immovable property, and now he decides to go and live outside India either for employment or otherwise, and he becomes a non-resident, correct? Of course, once you become a non-resident, if you go back to section 5, you are only taxed on income which accrues or arises in India. So let us say if those equity shares earn dividend income, or there are distributions from the mutual fund, or if in the future there is transfer of those shares or immovable property, definitely that would be taxable in India. Such a person can also avail benefits of the DTAA. Let us say that he moves to the UK or US or any other country. I think India has DTAAs with over 80 to 90 countries, right? So if there are beneficial rates for taxation of dividend income, interest income, etc., which have been prescribed under those treaties, then one can also avail that. But as far as the 115E provisions are concerned, that beneficial provisions would not apply.
I think this has a direct relevance with the agricultural land as well. See, being an NRI, you cannot buy an agricultural land or directly, indirectly invest into.
You cannot buy, but I think I think so. Also, probably the question also is what procedure or formalities need to be done under Fema. So, as you would know that once you become a non-resident, your savings account, you need to go and intimate your banker. Your savings account need to be converted into the NRO accounts. At the option, you can also open new NRE account, which is a non-resident external account where you can repatriate your surplus from your foreign earnings, and again any interest which you earn on those NRE accounts are not taxable in India. I think another practical point would be that if you have investment in shares, typically what they do is those investments would be treated on a non-repatriable basis, and you could continue to hold them, you could continue to trade, but maybe a new demat account procedurally is opened because under Fema there is separate counting for NRIs and residents. So I think those are some of the more practical aspects, but no income tax relevance, or just because you become an NRI, there is no trigger of taxation, which happens.
But since you mentioned about a bank account,
sure. Yes,
I will take your question, Bimal. So
Yeah.
since you mentioned about the conversion of the bank account, so it is of course mandatory to convert your saving account to NRO and as well as your demat account to a non-resident demat account. So the Fema rule says it has to be done in a reasonable period of time. So what is actually reasonable is a very big question.
Correct. So in my experience, generally what we advise our clients is, and typically what bankers also insist is they ask for a work visa or the visa of the overseas country where you are heading to before they convert your account from your ordinary savings account to an NRO or NRE account. And this would typically, in many instances, what happens is you're initially given with just a 30 or a 60-day visa, and then you obtain a residence permit outside India, or you're given a more permanent visa only later on. So what we advise our clients is, more often than not, they do come to India at least once a year to visit their family, and immediately on their next visit we ask them to approach the banker and get this conversion done. If you want to be extremely compliant with the law, you can always email to them, and I'm pretty sure in this day and age, if all the forms are properly submitted, the conversion, especially some of the more private banks, they have facilities with even branches outside India where they assist with this process.
Correct. And even they have started doing it online also now. So their net banking you can do. Yeah, Mr. Bimal, you had a question.
Yeah. So my question is, as I said, the resident becomes a non-resident, and as Mr. Parekh was saying, the demat account he has to intimate to the bank, and there is a possibility demat account might be converted into non-resident, but it won't be considered as a non-resident investment, right?
No, it will not be, because the original investment was never made in freely convertible foreign currency.
Yeah, so that is my major question, because the original investment in the resident currency, so it is a non-repatriable, and
and the original investment was always in INR. So
so either LRS or maybe the non-residential limit of 1 million will be applicable for the repatriation and all, after complying the 15 CACB and all. Okay, thank you.
So the next question is interest received on RFC, that is resident foreign currency account, by RNOR covered under section 1015?
Just a second. So if you look at the provision, interest paid by a scheduled bank on RBI approved foreign currency deposit FCI in our account is exempt. Definitely, I mean, to my mind, nothing here prohibits from claiming this exemption. The only challenge here is if you look at 1015, it applies only to non-residents. So if you're RNOR, can you still take the benefit of this? Is something which one will need to examine.
To my experience, sir, it would be covered, and the source of the money in the RSA should be through a foreign accrued income.
Correct. As in it cannot be otherwise.
Correct. So what about gifting of property by NRI to other resident who has acquired Indian property while he was a resident? Does any approval of RBI is required?
Can you, so again a Fema question, can you repeat? Is it there in the chat box?
Okay.
Yeah.
So Mr. Parekh, the question is, suppose a resident has acquired the property in Indian rupees in INR, subsequently becomes a non-resident.
Okay.
And now he wants to give the gift to the same, to the resident, or say to either resident or to a non-resident. In that case, suppose if he's gifting to a non-resident, will the RBI permission will be applicable? Because there is an RBI cap of $50,000 in acquiring any assets.
Correct. Again, something which I have not recently dealt with, but again, from memory, if a non-resident wishes to gift property which is located in India to a resident, there is no bar. A resident can freely accept it. Again, if a non-resident who was originally a resident, he wishes, your second question was if he wishes to gift this property to another non-resident. Again, I think limiting certain bar as far as agricultural lands are concerned. In my view, as far as if it's an NRI, again, and when I say NRI, I'm using the term loosely, but generally they should have overseas citizen OCI card holder. Because most of the Fema beneficial provisions are now linked to the OCI card. There should not be any bar in terms of this gift. Ajay, any practical experience of having?
Absolutely, you are correct at that point. There is no restriction or any approval required for this. You are free to give.
Because I came across some sort of a Fema provision which it says whenever NRI wants to, any resident wants to give gift to a non-resident, there is a cap of $50,000 for a year.
Yes, but not the other way around. So RBI always allows us to receive everything. But if you want to send money outside India, the cap would apply.
Okay, so resident to non-resident can give a gift or no? Resident to a non-resident. Suppose a resident wants to give, suppose let's say parents wants to give a gift to the son who is a non-resident of more than $50,000.
I've understood your question. So very simply within the constraints of the time, a resident wanting to give to a non-resident, Fema would become applicable and the limits would apply. However, if a non-resident is trying to gift to somebody in India, a resident person, clearly there is no restrictions or permissions and you don't need to check the limits applicable.
Okay, sounds good.
So there's the next question. If
I will contact you directly. No problem.
If a person gets a green card, then whether he will be considered as a NRI or need to check condition as mentioned in section 6.
So maybe not directly answering this question, but also somewhere related to the question which Bimal Bhai asked. One has to be very careful. I didn't put this slide, but one has to be very careful that the residential status as per Fema is different compared from the residential status as per the Income Tax Act. So, when we use the terms resident, sometimes we use it generally and without any reference to whether we mean a resident for income tax purposes or whether we mean a resident for Fema purposes. So always be careful that, at least in this presentation, unless, it's been specifically mentioned, everywhere we were talking about a tax resident or non-resident as far as the Income Tax Act was concerned, because the rule and the definition is completely different. Fema looks at intention, whereas income tax is a more objective rule where, we look at the number of days physical presence in India. Now, the question which has been asked is about whether a green card holder, if a person gets, I'll just repeat the question, if the person gets a green card then whether you will be considered as an NRI or need to check conditions of Section 6. Again, I think we are trying to confuse different provisions which are applicable. Now, let us take it step by step. If a person is a green card holder, there can be different scenarios. One of the scenarios is the person is physically in USA. Okay. Now, I am no expert on the US tax laws, but you will have to consult somebody in USA to figure out whether that person is considered to be a tax resident for US domestic tax law purposes, which will be step 1. Typically, a green card holder is considered to be a tax resident as far as US is concerned. Correct. But I don't want to, because I'm pretty sure there may be exceptions, there may be other things one needs to look at. Having said this,
maybe a tiebreaker rule can apply because
exactly. Having said this, then come to Section 6 of the Income Tax Act to determine, are you also a tax resident for Indian domestic tax law purposes? Correct. Only if you are an Indian domestic tax law resident also, then we go into this whole problem of you being a dual resident under the domestic law of 2 countries and you having to access the DTAA to figure out where do you tie break to as far as treaties is concerned. If you are only tax resident in the US, then you're simply a non-resident individual who has some income in India. Now, again, sometimes we use the term NRI very loosely. Are we talking about a non-resident Indian or a non-resident individual? Correct. So if you're a non-resident individual, again, your income is taxable in India as per, based on what we have discussed again, as far as whatever income accrues or arises in India. So so obviously for any individual, you'll always need to check Section 6, whether you are a resident or non-resident. And this would be irrespective of whether you are a green card holder, you're not a green card holder. It doesn't, you may have foreign nationality, you may not have foreign nationality, irrespective of that.
Right. Now, only one question, Siddharth Bhai. In case of a tiebreaker rule, in case of a resident of both the country, India as well as foreign country, as per your slide and as per whatever I did the study, the principal residence comes into picture as a vital role. So in case, if there is a tiebreaker, let's say the client is a resident of India also and US also, and he's only having a house in India, then will he be considered as a resident of India?
See, now
other factors as well.
No, so if you look at the tiebreaker rule, the tiebreaker rule provides a very clear hierarchy. Okay, and the tiebreaker rule is very clear as to the first tiebreaker rule essentially says where is the permanent home located. Okay.
Right.
So let us take the example that if the permanent home is only located in one of the 2 countries, okay, then he would tie break to that country. If you look at the commentary to the OECD Model Convention, a permanent home does not necessarily mean that you need to own the home. Even if a person has rented a place which is permanently available to him, such a home is considered to be a permanent home. So usually what happens in most cases, a person typically has a permanent home both in India as well as outside India where he is staying. The next step would be center of vital interest. Now this is, for example, let us say that if he has shifted outside India with his family and let us say he is working also outside India, then there may be more grounds to say that his center of vital interest presently are outside India and he tie breaks to the foreign country. But let us imagine a scenario where his family is in India, but he is working outside India. Now, within Article 4.2, or if you look at tax literature or the commentary, there is no precedence that the personal interest have priority over economic interest or vice versa. And again, it's a very fact-specific exercise. So what I can recommend to you is, if you're dealing with a practical case, you may look at the commentary to the OECD Model Convention, which gives a lot of examples for each of these tiebreaker rules, which obviously, while it is not binding, on the Indian revenue, but it will at least give us a guidance, or it will give us some rational basis for coming to a conclusion.
Right. I think fair point, Siddharth bhai, fair point. It's not that easy to interpret, but yeah, I need to go through the in between the lines and so many facts of the case. Yeah, thank you.
Yeah, moving ahead, I apologize first of all on behalf of because we have already passed the 15 minutes scheduled time, but we will definitely take up the questions as mentioned by the chairman sir as well. It is very important, and we'll take all the questions, and I request all the audience to stay on with us. Coming to the next question of Mr. Rahul Pareva, and this is a very interesting question. How withholding tax can be claimed by the YouTubers? Is it possible to take the treaty benefit? Whether they are required to file ITR in US to claim the refund, or they can simply take the benefit of FTC. What are the practical issues they can face, or what is to be submitted with Form 67 to take the FTC?
So I will simplify the facts again. So there is a person who is resident in India. This individual is earning income from foreign sources outside India. And of course, while here the example is of a YouTuber, it could be anything. You know, you could have income from dividends, capital gains, business income, etc. Very simply, what has happened is in the overseas jurisdiction, there is some withholding which has applied, which has taken place. Correct. So basically, you have received the income after deduction of tax in the foreign country. And the question is, what are the practical points or the nuances as far as claiming foreign tax credit is concerned? Generally, in our experience, what we have seen is whenever taxes have been deducted in the foreign country, what we first request our clients to do is to obtain a proof of deduction or payment of the tax in the foreign country. So you can actually take a look at Form 67 and the applicable rule. And what you will see is it lists down which are the proofs which are accepted by the income tax department and which should be uploaded at the time of filing of Form 67 for claiming of foreign tax credit. Generally, this includes any statement akin to our Form 16A. Second, it could also be a statement which has been certified by your employer in the foreign country, certifying the taxes which have been withheld and paid to the government authorities in the foreign country. They also have an option where the taxpayer himself has deposited tax directly to the foreign tax authorities. You can attach, whatever are the tax counterfoils along with the bank statements evidencing that the payment is made. When you file Form 67, what we typically do for our clients is we prepare a cover letter along with a detailed calculation and computation of what is the foreign income, how it has been reconverted back into INR, how the foreign tax credit in the foreign currency has also been converted back into INR, and what is the applicable tax rate on this income in India. Because remember, India follows an ordinary foreign tax credit method. What this means is you can never claim more credit, or you cannot, for example, if let's say the tax rate in India is 30% and you have suffered withholding tax at 40%, then you're eligible to claim FTC only up to 30%. Right? You can never, it can never be a scenario that you claim foreign tax credits which are over and above the applicable tax in India. Converse scenario, let's say the income is not taxable in India, but you have suffered some foreign taxes there. Very rare scenario, never come across this practically. But even in such a scenario, obviously, the Indian government is not going to subsidize or refund to you any foreign tax credits. Also, if there are excess foreign tax credits, one would not get a refund for that. So I think the real challenge here is to understand how you can get the correct documentation which evidences the taxes have been withheld from the foreign country, then file Form 67, and after that make the necessary disclosures in Schedule FSI, foreign source income, and Schedule TR, tax relief, and claim the relief under Section 90.
Okay, so there's a next question. A non-resident Indian has returned back to India for good permanently from Middle East during the pandemic and continues to work as a consultant on virtual basis, that is work from home. Okay. So he gets a consultancy income which is received in India after deduction of 10% withholding tax. whether the income will be treated as an income of a resident, what relief is he eligible against 10% withholding tax while filing the return in India?
So again, I think everything which I said in terms of taxes deducted in foreign country, Form 67, etc. is applicable. The only other check which needs to be done is, see, if you go through section 92 and also the rules on foreign tax credit, the relief is only available if the other country is entitled to do the withholding as per the provisions of the DTW. Now, this examination needs to be done. Correct. So you are saying that there is a person who has permanently returned back to India. So let us not call him an NRI. He is a tax resident as far as Indian income tax is concerned. And he is earning some income from foreign sources. So what one needs to do is, if there is a treaty in place between India and that foreign country, let us assume it is Oman, let us assume it is UAE, etc. Then one needs to examine that on the payment which one is receiving. Let us say it is fees for technical services. And let us assume that under the India-Oman treaty, the tax rate under the treaty is also 10%. And that is the rate at which the withholding has happened. In that case, obviously, you will be eligible for relief subject to, you obtain the proofs, file Form 67 and claim the relief. But let us say that it is not fees for technical services. It is actually business income. And because you don't have a PE in that country, Oman should not have withheld any taxes. In such a scenario, obviously, the Indian tax authorities would say that Oman never should have withheld the tax. And in such a scenario, what you would do is you would need to actually reach out to a tax consultant in Oman. You would have to tell them that while under Oman's domestic law, a withholding has happened, as per the treaty, there should not have been a withholding. And what is the process to claim back the refund from the tax authorities in that country? So that is the practical process which you will need to go through.
Correct. So next question, if a non-resident receives amount in NRE account, then whether it is taxable in India as per section 9, income received in India or deemed to be received in India?
To my mind, no, because typically NRE account is only used where you have surplus savings or investments outside India, and you use that to repatriate to the NRE account. Unless the question is, let's say a person in India is directly making a credit to an NRE account. In that sense, obviously the income would be taxable. So again, don't go by the nomenclature in terms of NRO account, NRE account. Go by what is the source of the income. If the source of the income is in India, then even if you are a non-resident, any income which accrues, arises, or has a source in India will always be taxable in India. However, if the source of income is outside India and you are a non-resident, it will not be taxable in India. And simply a credit to an NRE account by itself is not considered as receipt in India, if that is the question.
Correct, because it is a possibility that a non-resident selling a property to another non-resident, transfer can happen through NRE, but subject to
you would have typically in such scenarios, you would already have gone through a 15 CSEB, withholding would have applied under 195. So you would never credit proceeds to an NRE account. Bankers would never accept credits to an NRE account without 15 CSEB. In fact, even for one owns account from NRO to NRE, they insist on a 15 CSEB. So correct. All the taxes have been paid. So in practice, should not be an issue.
Yeah. So what about ITRU covering section 139(8)(a)? Is it applicable for NRI?
I'll be honest, I haven't taken a look. But homework for me to take a look if if the return can be revised. To my mind, there should not be any bar, because if I recollect the words of the finance minister, essentially what they are saying is you disclose the additional income, you pay tax at a higher rate, and we will waive off interest and penalty. If you're offering to pay more tax and do the disclosures, I don't see why it should be restricted only to residents. But I have not taken a look at it, so I'll not comment.
No, I would second your opinion on that, Siddharth. So, how will salary payments from Indian company to a non-resident be taxed?
Okay, so again, very simple scenario. Essentially, the question is, there is a domestic company. The domestic company has hired a person who is outside India. And the question is, would you end up deducting TDS? And the answer is yes, under 192. Because go back to the fundamentals, right? I mean, we cannot forget, what are we talking about? We are talking about salary income. Does this income accrue or arise in India? It does, because it is from employment, right? So the payee is an Indian company. If you look at section 9, it would be covered. So and section 195 does not apply in case of employment income. So yeah, TDS would apply.
One doubt, whether it is TDS is under section 192 or 195.
In my view, it is 192, because 195 is a carve out as far as salary is concerned.
Because he is an NRI, so is it?
Yes, but 192. So just a second.
195 should override 192. Yeah.
Yeah. Because 195 is the basic section for payment to NRIs.
So if I can share my screen, just a second.
But then what would be the basis of calculating the TDS on the income? If you consider it to be 195.
Just a second. Just a second.
So meantime, he shares the screen.
Yeah.
You are done? Okay.
So this is section 195, and it says any person responsible for paying to a non-resident not being income chargeable under the head salaries. So 195 has a carve out as far as salaries is concerned. Now let us look at 192. Yeah, any person responsible for paying any income, okay, under the head salaries at the time of payment. Does it say only to residents?
Okay, thank you.
Yeah.
Thank you for the clarification.
So instead of a question, there is a very good comment which has come up. Why most of the NRIs don't file their tax return?
I think it is our ignorance. I think it's our ignorance sometimes where we don't advise our clients correctly. Also, one very practical case which we were discussing in one of the study circle meetings which I attended was, see, one of the other benefits of filing returns for NRI, sometimes they say that, we have only NRE income or interest earned on NRE accounts, anyways it is exempt. So one of the benefits was, let's say if you regularly file your returns and you disclose this to tax every year, and then let's say if in the future you become a resident, then at that point in time, when you bring everything back to India, you have already disclosed to tax, all the past income. And at that point of time, if a scrutiny comes, you don't need to then sit and explain when the interest income was earned, why it was not taxable, etc., etc. So I think some of the finer nuances get mixed when people simply say that, I'm a non-resident, will not, file the return. Why is it applicable to me? Why should India decide where I'll file the returns? Things like that. So we need to be more, we need to explain to our clients some of the softer benefits of being compliant in situations which may arise in the future, not necessarily the present.
So rather, they should be converted more into a opportunity. And
Correct. No, I think
in fact, to add your point,
yeah,
there are scenarios where, of course, an individual might not have any income in India, but what about if he has 5 properties in India? So if there is a concept of deemed rental income, then
100%.
So even though there is no credit, he might not have a bank account, but there is a deemed rental income coming. He is
and very common, and very common as far as non-residents are concerned. Extremely common.
Correct. Okay. So please share your views on the applicability of significant economic presence by amendment applicable from financial year 21-22 and precautions for compliances.
I think some of the questions are such that we can probably break for lunch and come back for another session.
There is a good question. What about the TDS rate for purchaser purchasing property from any NRI, and under what section? Is there any purchase limit for this?
So essentially, you're saying
So
that
the payment for a purchase of immovable property, you have to deduct TDS at a rate, higher
at
rate.
20
So
at the rate of
20%.
20% under 195.
Yeah.
And it will be on the gross sale consideration, which typically nobody likes. So you go for 197 application and form 13.
Yeah.
But do remember, whenever all the rates which are mentioned, do remember surcharge and cess needs to be added. Otherwise, you will get a nice little inquiry intimation from the TDS processing CPC saying where is surcharge and cess.
Whether you need to file the return if the NRI are having only income referred to in section 115.
No, because 115 has a specific exemption in place. So 115E has the tax rates, and my slides cover under which section there is an exemption. But provided only the income which is covered by those sections is there, the slides cover this. There is no requirement. But again, in practice, I would always say it's better to file returns. I mean, think about it. Returns are required for proof of visas. Returns are required by buying insurance policies to evidence income. I mean, it simply isn't. And if you are a non-resident and the other country follows worldwide income taxation, that country may want to aggregate the income which you are getting in India. Correct. Now, if you don't file a tax return in India, imagine having to prove what you have earned in India. Vis-a-vis if you already have a ready-made computation wherein you have disclosed the income. So again, let us not look at things in silos. There are many practical aspects which we can look at, and then advise our clients.
I think this is a repeated question. In case of a sale of property, seller was resident till financial year 21-22, but has recently shifted to UK and intends to settle down in UK. What TDS rate should buyer apply? Buyer of property should deduct TDS at 1% under 190 for IA, or consider the seller as NRI and deduct TDS at 20%. So of course, as you have
I think
answered,
if you do it in the previous year where is a resident, 1%. If you do it in the current year when is a non-resident, 195 at 20%.
Yeah. There is another question. In case of a foreign national pilot on Indian company payroll, however stays in US for more than 183 days while performing duty and becomes resident of US. In this case, whether any tax withholding or taxability arises in US, or TDS will continue to be deducted by Indian company and deposited in India.
Maybe I'll take this question online because there are a couple of points to it. One is what happens in the US. I'll not comment on it. Secondly, what I want to check is while there is for members of ships and crews, there are specific provisions which apply. So if those extend also to pilots, one needs to look at. The question is silent on whether while he may be, because typically in case of ships, what gets taken into account is, whether it's an Indian flag or not. So whether it's an Indian ship or a foreign ship. So I think there are specific, it's a very specific question, not dealt with it in practice. So I'll
in fact, we need to add the inbound or outbound ship as well. Now, origin of the, it applies here, both the scenarios.
Correct.
So we can definitely take this question in person. So next question is whether we need to add surcharge and cess in case DTAA rates get applied.
No. So there are again plethora of decisions that the rates which are there in DTAA. So typically interest, income, royalty, dividends. That is the maximum rate which can be charged. So many a times, you may find 10% under the treaty and you may find 10% under the Act, 115A, royalties, fees for technical services. Still, it is beneficial to go under the DTAA because when we say under the treaty, it is 10%, whereas under the Act, one needs to add surcharge and cess. So always, so to answer you, no, we don't need to apply surcharge and cess. And a lot of decisions again in this regard.
Ajay, may I interrupt for a second?
Please, sir.
Yeah, wherever we have found that the question are based on some other country taxation or are not in practice other than Fema, even if they are in Fema, what I may request you ask for the email from your members and send it at Citex and a copy to me. I will try to get you the answer. Give the I'll route it through your branch only. Okay.
Right, sir.
So,
Noted. Thank you.
So
Thank you.
all the queries should be answered. The cash should be telling with the cash in hand. Okay.
Noted. I request all the members who have joined can drop their query as well to nagpur@ici.org, and we can forward and get you connected for the same. I think we have done with the question and answers, at least to the chat bot. Any member who would like to specifically add on the question, please feel free to raise your hand, or else we can conclude this session. Okay, I think we are done, and I think there is someone who wants.
Sir, actually, मेरा एक question था. I have one question that's similar to YouTube question. As you have said कि ESOPs के बारे में actually था. So one of our client has received the ESOPs of Zomato. So what being a resident, for that year he is becoming a resident, and for that his global income is taxable. Actually, he has served in Turkey and Indonesia as well, and there was some vesting period at that point of time. So what they have done is they have cross charge. Actually, the taxation has been cross charged. So Turkey or इंडोनेशिया में भी तो वो उसका पोर्शन उन्होंने डिडक्ट कर लिया, और बीइंग अ रेजिडेंट इंडिविजुअल उन्होंने ग्लोबल इनकम में भी कर लिया. सो बेसिकली माय क्वेश्चन इज व्हाइल फाइलिंग फॉर्म 67 व्हाट शुड आई एक्चुअली, क्योंकि समटाइम्स दे गिव द बेनिफिट, सीपीसी गिव द बेनिफिट ऑफ एफटीसी एंड समटाइम्स दे डोंट. सो इज देयर एनी शॉर्ट रूल दैट वी शुड कीप इन माइंड एंड take the benefit of FTC? What are the documents actually? These are the basic documents you should actually submit with your form 67.
So I'll not very specifically comment on your facts because it's slightly complicated. But what I'll advise is we have been routinely claiming foreign tax credit for our clients over the years, and the basic rule is foreign tax credit can only be claimed for tax residents. So if your client is a non-resident, then there will never be a scenario he can claim foreign tax credit.
He is a resident.
If he is a resident and worldwide income is taxable, and one is able to determine that taxes are validly withheld in the other country as per the DTAA, which India has entered into with that foreign country, then there is no reason why India will deny you the claim for foreign tax credit. See, this is what the law is. Now, as far as procedure is concerned, each country and each situation will be different. How do you evidence that the taxes have been paid in the foreign country? Typically, if you are talking about ESOPs, there will be some statement which is certified by the employer of that country, correct? Which will say that this is the gross income, this is the amount of withholding which has happened, which we have deposited, etc., etc. Right. Correct. And when you file Form 67, simply don't attach all the attachments. You know, have a covering letter with the computation, with proper references,
explaining the whole situation,
explaining the situation, and explaining, you know, annexure 1 has this document, annexure 2 has this document, annexure 3 has this document, so that what happens, the officer who is examining your case, it becomes easy for him. If his life is easy and he understands what you are trying to do, then at least in our experience, we have never been denied foreign tax credit. As long as, you know, we have followed the entire process properly. Ajay, I don't know if anything further.
Yes, one more. I think we will take the last question. I would request Mr. Rajesh to unmute and ask, please. We'll take this as the last question, and rest of the questions can be followed through an email. Mr. Rajesh, are you there? Okay, I think he just raised the hand and has missed. So, right, thank you so much, Siddharth. It was an excellent session. Almost there are 20-25 messages in the chat box. And on behalf of everyone at Nagpur branch, I'm thankful to you for taking out time from your busy schedule and addressing the members at large on this very interesting topic. I am also thankful to the chairman, CS Sanjay Kumar Agrawal, sir, who is heading the international committee. Sir, thank you so much on behalf of Nagpur branch for giving this opportunity to host this session.
Thank you. Thank you. Keep on doing good work and organize as much program as you want, and take some entrepreneurs also here so that they should know we can solve their queries also.
Thank
Definitely
you,
looking
Sanjay
forward.
bhai, thank you Ajay bhai, thank you Jitendra bhai, thank you for this opportunity, because I feel with this opportunity I got a chance to brush up my knowledge, relook at all the provisions again, because this is the best learning which can happen amongst our peers. So thank you for the opportunity once again.
I would like to also thank Central Council member and the Vice Chairman of the committee, CA Cotha Srinivas, at the same time in absentia. And I also extend my thank to all the members who have joined in large from various parts of the country for having your presence felt. And I'm sure you are benefited out of this deliberation. Stay updated at nagpurici.org for the upcoming events. Thank you one, thank you all. I hereby conclude this meeting. Thank you, Sanjay.